Good morning. Welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. So we've got a good topic for you here today. We're going to talk about the solo 401k setup deadline for tax year 2025 for those who are taxed as a sole proprietorship or their self-employed business as a sole proprietorship. And this deadline deals with the Mega Backdoor Roth solo 401k for tax year 2025. So this is your chance to get answers. Use the chat to ask questions on today's topic or anything else. Type them over now so that we can be sure to get to them all. I think I see some questions here. I thought this was for questions regarding my 401k trust. As I stated at the beginning of the webinar, this is your time to ask questions. It doesn't have to be about today's topic. It can be about any topic surrounding solo 401ks and even self-directed IRAs. Just chat them over and we'll be sure to get to your questions. Will there be a chance to ask individual questions? Certainly. As I stated, this is your opportunity to ask questions regarding today's topic or any other aspect about solo 401k plans, as well as self-directed IRAs. Here's a question here. How much does my husband need to make to be eligible for contributions to the solo 401k? Does it need to be on payroll or can it be by a check? What is the maximum contribution level direct by the company for 5,500 easy? If we transfer funds from 401k to IRA, should we wait to file a tax form before doing so? If not, would it be last balance before transfer? When will the solo 401k be ready to receive contributions? For 77,500, can it all be one check from the LLC? Well, one, make sure I understand your questions here. In order for your spouse to participate in your plan, he or she has to be self-employed in the business. So a solo 401k plan can be utilized by both spouses, provided both spouses are self-employed in the same business. If you look at this slide here, here's an example of a two-participant plan. That is, if two spouses are working in the same business. So if both spouses are self-employed in the same business and neither spouse owns any other business that employs full-time W-2 employees who are not owners, then you can both participate in the same solo 401k plan because the plan is sponsored by the business, in this case, the LLC. You would each have separate holding accounts, aka bank or brokerage accounts under the plan to hold your contributions. So here's an example of a two-participant plan with 6 separate brokerage or bank accounts, aka holding accounts. You've got a pre-tax solo 401k holding account, a Roth solo 401k holding account, and a voluntary after-tax solo 401k holding account. So 3 each for each spouse for a total of 6 holding accounts under the plan. And contributions to the plan would be based on each separate spouse's earned income from self-employment activity. So regarding how much you can contribute depends on how your self-employed business is taxed with regards to the calculation. But the overall contribution limit for tax year 2025 is $70,000 for someone who's under age 50. If you are age 50 or older, then you can contribute a catch-up amount of $7,500 in addition to the $70,000 normal contribution limit for a total of $77,500. There's also the super catch-up contribution that applies to those who are a certain age, specifically age 60, 61, 62, or 63. If you fall within that age range in tax year 2025, then instead of contributing the $7,500, what I like to call the normal catch-up, you can make an $11,250 super catch-up contribution. It can be both, but you can instead contribute the $11,250 super catch-up for a total of $81,250. Of course, you have to have the necessary self-employment income to justify these contributions. And let's see, you were asking about, as far as the flow of the contribution, you can make contributions periodically, or you can make them in one lump sum. They don't have to flow through payroll either. Most solo 401k clients don't use payroll because it's not a traditional 401k where you've got hundreds of employees. A solo 401k, it's just you. So you can make the contribution by writing a check or by linking your bank account to the solo 401k holding account if you use Fidelity Investments to hold the solo 401k funds for the plan that we offer. And you can make the contribution by your business tax return due date plus timely filed extension, and that's going to be driven on how your business is taxed. So if you're looking to make a contribution for tax year 2025, for example, and you already have a solo 401k plan, then you're going to have until, let's say your business is taxed as an S corporation, let's say as an LLC tax as an S corporation, you're going to have until March 15 of tax year 2026 to make all contribution types, whether employee, employer, or voluntary after-tax contributions. So you're not required to make any contributions by December 31st of 2025 if you already have a solo 401k. So it doesn't have to flow through payroll, in short. As far as your 5500 easy question, the 5500 easy is an informational return that applies to a solo 401k plan once the market value of that plan is greater than $250,000 as of December 31st of the plan year. So for example, if your plan year ends December 31st, if the market value of all funds in your plan, so all the brokerage accounts under the plan or bank accounts under the plan, including all participants, so you and your spouse, for instance, if you both have funds in the plan, all the assets, you have to add up all those amounts. And if when added up together, the market value is greater than $250,000, then a Form 5500 Easy would need to be filed by July 31st of 2026 for year 2025. That's the service we provide to our clients who timely request it. And we'll file it with the IRS as well electronically. We don't charge extra for that service as long as you timely request it. Because keep in mind, we don't have access to your funds. So you need to make sure you let us know if you want us to assist in preparing that Form 5500 Easy, or you can have your CPA do it instead. But many of our clients will have us handle it for it because we don't charge extra for that service as long as you timely request it. All right, good question. Let's see, you're saying, another question here. My spouse is employed with another business, but does not have a retirement fund. He also does part-time work for my business. Okay, great. So if he's not on the plan already, we can add him to the plan. You'll want to submit a support ticket on our website. Let me provide that support link. You'll submit a support ticket and we can add your spouse to the plan because the plan will have to be amended so that your spouse is on the plan, and then we can assist in helping him open his holding accounts. And then he'll be able to make contributions to the plan as well based on his earned income from self-employment activity in the same business. Same business meaning your business, the LLC in this case. Let me share that link with you here. Here's a link to submit a support ticket on our website, and we can add them to your plan. All right, let's see here if we have some more questions here. We'll come back to some more of these questions here in a moment. In the meantime, let's get started here with today's topic, and then we'll come back and answer some more questions. But go ahead and chat over your questions. Again, it doesn't have to be about today's topic. It can be about any aspect about solo 401k plans or even self-directed IRAs. So we're talking about, the main topic today is the Mega Backdoor Roth Solo 401k for tax year 2025. The setup deadline for a sole proprietorship or an LLC tax as a sole proprietorship. So we're going to talk about why the Mega Backdoor Roth Solo 401k matters, the December 31st setup deadline, contribution buckets explained, aka bank or brokerage accounts, which are the holding accounts for the plan, how sole proprietors hit that $70,000 overall contribution limit. Keep in mind that the Mega Backdoor Roth Solo 401k consists of making voluntary after-tax solo 401k contributions. And regardless of your age, whether you're under age 50 or older, the maximum voluntary after-tax solo 401k contribution you can make to a solo 401k plan is known as the 415 overall limit, which is $70,000. You cannot contribute more than that to the voluntary after-tax solo 401k as part of the Mega Backdoor Roth strategy. We're also going to talk about why brokers don't offer the Mega Backdoor Roth and how my solo 401k financial supports all buckets. Of course, before we can even talk about the deadline for the Mega Backdoor Roth solo 401k strategy, if your business is taxed as a sole proprietorship, you first need to make sure you're eligible to open a solo 401k plan, regardless if you're going to utilize the Mega Backdoor Roth strategy or not. So a solo 401k is for the self-employed, for owner-only businesses that do not employ non-owner full-time W-2 employees who work 1,000 hours or more. Of course, there's a spousal exception. Your spouse doesn't have to be an owner in your business in order for him or her to participate in the plan. He or she just has to work in the same business in order to participate in the same solo 401k plan as you. And we kind of covered that already by answering that question we had earlier. Now, you can always exclude anyone who's under age 21 from participating in the plan, even if that individual is a W-2 employee and works 1,000 hours or more. Don't confuse that W-2 employee rule with self-employed businesses tax as an S-Corp, because with an S-Corp, if that's your self-employed business, you are a W-2 employee. But the distinction is that you're an owner in the business or you're the spouse of the owner. But if you do employ other W-2 employees that work 1,000 hours or more in your business who are not owners and who are age 21 or older, then you would now be eligible to open a solo 401k plan. You can always exclude anyone that works as a contractor under your business. Now, don't confuse that either with a contractor being eligible to open his or her own solo 401k. All right, let's keep going here and then we'll take a look at some of these questions here. So the deadline for voluntary after-tax solo 401k contributions when your business is taxed as a sole proprietorship. So technically, you have until April 15 of tax year 2026 to open the solo 401k plan and make voluntary after-tax solo 401k contributions for tax year 2025. Now, if you missed that April 15 of 2026 deadline, you could still open that plan by October 15 of tax year 2026 if you file for a business tax return extension. In this case, if you're a sole proprietorship, it would be if you file a Form 1040 tax return extension. That would allow you to both open that solo 401k plan by October 15 of 2026, as well as to make contributions, that is voluntary after-tax solo 401k contributions, by October 15 of 2026. And those would be year 2025 contributions. So in theory, you have plenty of time, if you're a sole proprietorship, to open the solo 401k plan to make voluntary after-tax solo 401k contributions for tax year 2025. However, why wait? Heck, you might forget about it. So if you still have time and you're listening to this webinar now here in 2025, you still have time to go ahead and just open the plan by December 31st of 2025, and then you'll still be able to make voluntary after-tax solo 401k contributions next year by April 15 or by October 15 if you file a timely business tax return extension. So again, in short, you have plenty of time to execute or process the Mega Backdoor Roth Solo 401k strategy for tax year 2025 if your business is taxed as a sole proprietorship. Now, if you're listening to this webinar in 2026, it's good to know that if you haven't yet opened the Solo 401k plan, you have until these deadlines, April 15 of 2026, to open the plan and then make contributions. That's voluntary after-tax solo 401k contributions, which is part of the Mega Backdoor Roth strategy. Or if you file for a timely Form 1040 tax return extension, since your business is taxed as a sole proprietorship, you would have until October 15 of 2026 to both open the solo 401k and make that voluntary after-tax solo 401k contribution for tax year 2025 by October 15 of tax year 2026. All right, let's take a look at some questions here. We got a question here from, looks like Lucas. Is the $650 setup fee a one-time fee? Can you differentiate between the employer and employee contributions for a client that is 50 years old who has maxed out his W-2 401k? No, it's not a one-time fee. Setting up a solo 401k is not just a one-time setup. A solo 401k is a retirement trust, and you are required to have a solo 401k plan provider. So if you're a client of my solo 401k financial, the first year fee is $650, which covers you. Let's say you set up a plan here in November. That $650 fee would cover you from November of 2025 to November of 2026. And then we would invoice you next year in November for the following 12 months. Our annual fee is $125. And that's for being the solo 401k plan document provider. Again, you're required to have a solo 401k plan document to not only open a solo 401k plan, but continue with the solo 401k plan. So a good question. You can find out more about our pricing on our website under the pricing tab. With regards to making contributions, the employee contribution, which is that $23,500 limit for tax year 2025, that's aggregated between all your 401k plans. So if you have a daytime 401k, let's say you work for Walmart and you participate in the Walmart 401k, if you max out that employee contribution to that Walmart 401k, you're not going to be able to make any employee contributions to the solo 401k plan. However, employer contributions, known as profit sharing contributions, those are not subject to the aggregation rules. So if the Walmart 401k, if Walmart makes a profit sharing employer contribution to your Walmart 401k, you're still going to be able to make a profit sharing contribution to your solo 401k. So those are not aggregated. Then there's the voluntary after-tax solo 401k contribution. Those are not aggregated either between 401ks at your daytime job and your solo 401k. So they're separate. So even if you maximize your contributions to your Walmart 401k, whether employee, employer, or voluntary after-tax, if that Walmart 401k allows for voluntary after-tax contributions, even if you hit that overall limit of $70,000 for tax year 2025 with the Walmart 401k, you're still going to be able to contribute $70,000 in voluntary after-tax solo 401k contributions to your solo 401k because those are not aggregated across all 401k plans. So as a result, you can really supercharge your retirement account savings by utilizing the Mega Backdoor Roth strategy with the solo 401k plan. Of course, contributions to that solo 401k plan are going to be based on your earned income from self-employment activity in your business, not your W-2 wages from the Walmart employment. Good question. All right, let's keep going here, and then we'll go ahead and come back and answer some more questions. So what is the Mega Backdoor Roth? Well, it's a strategy where you utilize after-tax funds, kind of like when you make a Roth solo 401k contribution. Those are after-tax funds. However, with the voluntary after-tax solo 401k contribution, it's a way to indirectly get more Roth funds into your Roth solo 401k plan above the typical Roth solo 401k contribution limits. So as I mentioned a little bit earlier, with the Mega Backdoor Roth, you can make a voluntary after-tax solo 401k contribution up to the overall limit of $70,000 and immediately convert that to the Roth solo 401k or to the Roth IRA for that matter. Now, most brokerage firms out there don't support the Mega Backdoor Roth, and that's probably because they don't want to deal with the intricacies of it and their reporting. I mean, it takes a lot of support to provide the Mega Backdoor Roth strategy. So here in my solo 401k financial, we obviously offer it and we specialize in it. But Fidelity, Schwab's of the world, they don't want to deal with it. They don't make money off of explaining the regulations and doing reporting. They make money off of your deposits. So Fidelity and Schwab, even though they don't offer the Mega Backdoor Roth, they'll provide brokerage accounts known as company retirement brokerage accounts for the Mega Backdoor Roth for a solo 401k plan offered by my solo 401k financial. So yes, they'll gladly hold on to the funds because they know that my solo 401k financial is the one that offers the plan that allows for the Mega Backdoor Roth. We're the ones that will explain the regulations to you. We're the ones that will perform the Form 1099-R reporting for the Mega Backdoor Roth. We're the ones that will educate you on how to report that on your taxes and so forth. So that's why, in short, banks, brokerage firms don't want to deal with it. It's a lot of work from a 401k provider perspective. Now, the contribution limits for tax year 2025 as part of the Mega Backdoor Roth strategy, as I touched on earlier, the overall limit is $70,000. You cannot contribute any more than that as part of the Mega Backdoor Roth strategy. However, that doesn't mean you can't make other types of contributions. Those just cannot be used for the Mega Backdoor Roth strategy. For example, if you're age 50 or older, you can do a catch-up contribution of $7,500 for tax year 2025. You can deposit that $7,500 directly into the Roth Solo 401k or the pre-tax Solo 401k bucket. And if you're age 60 through 63, instead of contributing $7,500 as a normal catch-up contribution, you can make a super catch-up contribution of $11,250. And that can go into the Roth Solo 401k bucket or the pre-tax Solo 401k bucket for tax year 2025. Finding your magic number, income needed to max voluntary after-tax contributions for tax year 2025. So today's webinar, again, it's regarding maximizing your contributions for the Mega Backdoor Roth Solo 401k. If your business is taxed as a sole proprietorship, and we're talking about the deadline to open and fund that Solo 401k as well for the Mega Backdoor Roth strategy. We're going to be doing future webinar series on the different entity types like an S-Corp, partnership, and so forth, as well as the other contribution types. But today's webinar is based on the Mega Backdoor Roth strategy, the deadline to set that up for tax year 2025. So if your goal is to maximize Roth and or voluntary after-tax contributions to build tax-free retirement wealth, then we oftentimes get the question, how much earned income from self-employment activity do I need to make from my sole proprietorship so that I can maximize my contributions. Well, here's a good slide for you. So if you're under age 50, the maximum Schedule C line 31 self-employment income you're going to need to pay yourself is $75,322. This is for tax year 2025. That's what these figures are. And you can contribute that entire $70,000 as a voluntary after-tax solo 401k contribution. Or you can say, well, I'm going to make these other types of contributions here. Employee contribution, and then I'm going to do some voluntary after-tax. So this is a good slide for you. But if you're trying to utilize the Mega Backdoor Roth strategy for tax year 2025 in your self-employed business, is taxed as a sole proprietorship, the maximum Schedule C line 31 income you're going to need from your self-employed business is $75,322. So that you can maximize the Mega Backdoor Roth for tax year 2025. And then we've got some other information here for those that also want to make Roth solo 401k contributions. You see the amounts outlined here. So if you're between ages 50 and 59 and you want to make some Roth solo 401k contributions in addition to the overall voluntary after-tax solo 401k contribution for tax year 2025, you're going to need to report at least $83,392 of Schedule C line 31 self-employment income. If you're age 60 through 63, you're going to need to report at least $87,427 of Schedule C line 31 self-employment income if you want to make the overall voluntary after-tax solo 401k contribution and then the Roth solo 401k contribution. So remember, voluntary after-tax contributions can be moved to the Roth solo 401k, that means converted, or they can be converted to the Roth IRA. You get to choose. Let's take a look at some more questions here, and then we'll come back here and look at some more information. So we got a question here. I believe the client who is 50 has maxed out his W-2 401k. Can he contribute $77,500 to a solo 401k with my solo 401k financial? Please confirm and help you all about it. I'm trying to actively work on this case. Well, so as I mentioned a little bit earlier, if you're trying to, let's see, if he's already maxed out, he's 50, has maxed out. Well, has he maxed out his entire contribution to his daytime job? Meaning, has he contributed a total of $77,500? If that's the case, then he's not going to be able to make any employee contributions to the solo 401k plan. However, he is going to be able to make employer profit sharing contributions. So that's a different test. So that's a 25% contribution if it's an S Corp, or LLC taxes an S Corp. He can contribute 25% of his self-employment income to the solo 401k. Or if he's trying to maximize his Mega Backdoor Roth using the solo 401k, that's not going to be impacted by his contributions to his daytime job 401k. He's going to be able to contribute $70,000 as a voluntary after-tax solo 401k contribution and then immediately convert it to the Roth solo 401k. And then if he's age 50 or older, he's not going to be able to do a catch-up contribution if he's already maxed out that as daytime employer 401k. So in short, looks like he's going to be able to make employer contributions and or voluntary after-tax solo 401k contributions, or just voluntary after-tax solo 401k contributions. So yeah, he can utilize the Mega Backdoor Roth, regardless if he's already maximized all his contributions to his daytime job. That's what makes the Mega Backdoor Roth so popular among high-income earners. So good question. All right. Got a question here. My investment managers are at Wells Fargo and they are prepared to manage the funds in the new solo 401k. Your team was not aware that Wells did that through, they asked them questions. Yeah, so you can certainly utilize my solo 401k financial as your solo 401k plan document provider. That's why we charge the annual fee of $125, but we'll also take care of Form 55 under the easy reporting, Form 1099-R reporting at no additional cost, as long as you kindly request that. That's all covered in our ongoing fee. But yes, many of our clients utilize Wells Fargo to hold the solo 401k funds because our plan is all the bells and whistles. So you can utilize the Mega Backdoor Roth strategy. You can process solo 401k participant loans. You can invest in alternative investments like real estate, crypto, precious metals, you name it, all types of investments. It also comes with a $1,500 tax credit known as the auto contribution credit. And you're not required to contribute in order to have access to that auto contribution credit. So that might be a reason to set up the solo 401k plan by December 31st of 2025 if you're listening to this webinar here in 2025. Because you can start claiming that $1,500 tax credit here in 2025 over a 3-year period consisting of $500 increments. Let me pull that up here. So here's information on the auto contribution credit. You have to open a solo 401k plan with a provider such as my solo 401k financial, who provides a plan that has the auto contribution credit built into it. It wasn't available till January 1st of 2024 and after. So if you're a client of my solo 401k financial from December 31st of 2023 and prior, we would need to amend your plan so that we can add the auto contribution credit. On the other hand, if you are a client of my solo 401k financial from January 1st of 2024 and after, we've already drafted the plan for the auto contribution credit. And if you're opening the solo 401k plan for the first time here in 2025, then that credit will be built into your plan. And it's a dollar for dollar credit for a total of $1,500. So the cost of opening a plan and maintaining a plan for many years will be covered under this $1,500 auto contribution credit. And you're not required to contribute in order to have the auto contribution credit. In other words, you can still take advantage of the auto contribution credit and you can still make contributions to the plan up to the overall limit, or you can choose to not contribute at all. And you're going to file Form 8881 for a total of 3 years because you have to spread that $1,500 auto contribution credit over a 3-year period. So $500 for tax year 2025, $500 for 2026, and a final $500 amount in year 2027 for a total of $1,500. So you would file Form 8881 each year for that $500 amount. We have a video walkthrough, a PowerPoint walkthrough. The form is not that tough to fill out. So that's how the auto contribution works. Okay. So thanks for the great questions. Let's continue here. Go ahead and continue to chat those questions over and we'll go over them. If this information is helping you feel more confident about your future, please take 1 second to like and subscribe. It tells the platform that this content is valuable, which helps other solopreneurs like you to find it. Subscribing also guarantees you get notifications of all our crucial content that we deliver every day to secure your retirement. For example, we'll be going live again here in a couple hours. Yes, it might be Thanksgiving Eve, but we're still hard at work here. Okay, let's continue here. So we talked about this slide already. Let's take a look at the next slide. Special considerations for day job and side business. So if you have a day job and you contribute to that employer-sponsored retirement plan, So let's say you work for Apple. So you participate in the Apple 401k, you're a W-2 employee of Apple, but you also have your own side business. So you're a go-getter. You have your own self-employed business on the side. Well, you're going to be able to contribute to that solo 401k plan as well. So, as I touched on earlier, each contribution type has its own set of rules. So employee contributions, which is $23,500 for tax year 2025, that limit is shared across all your 401k plans. So your daytime Apple 401k and your solo 401k. So if you've already maximized that $23,500 contribution to your Apple 401k, you're not going to be able to make any more employee contributions to your solo 401k. You're tapped out. Now, employer contribution limits, those are not impacted by contributions to your daytime job 401k. So even if Apple made an employer profit sharing contribution to your Apple 401k, it doesn't matter. You're still going to be able to make employer profit sharing contributions to your solo 401k. So that's great news. And then there's the voluntary after-tax solo 401k contribution as part of the Mega Backdoor Roth. Those are not impacted either by any contributions made to your Apple 401k. So even if you've maximized your contributions to your Apple 401k, the $23,500 employee contribution plus the profit sharing or even the catch-up, those do not impact your Mega Backdoor Roth strategy, that is making voluntary after-tax solo 401k contributions. So therefore, if you have enough earned income from self-employment activity for your side business, regardless if you maxed out your contributions to your Apple daytime job 401k employer plan, you can contribute $70,000 in voluntary after-tax solo 401k contributions to the voluntary after-tax solo 401k bucket. So this bucket right here, and then turn around and convert it to the Roth solo 401k. Talk about a deal. Of course, you have to have the necessary self-employment income from your side business to justify that contribution. So the key takeaways are that your magic number depends on what type of contributions you want to maximize. Employee only, employee and employer, or just maximize the Roth through the voluntary after-tax, in which case that's not going to be impacted by any contributions that you make to your daytime job. Now here's an exception that applies to 457 governmental plans as well as 403B plans. 403B plans are plans offered for in the medical field or in the educational field. So if you participate in a 457 governmental plan, you don't have to worry about any of these limits here. In other words, you can still make employee contributions, employer contributions, voluntary after-tax contributions, or a mixture of all those, even if you've maximized contributions to your 457B plan. So it really pays to be a governmental employee. I guess it depends who you ask. Now, if it's a 403B, it's not quite as advantageous. So with the 403B, you're going to have to look at all of the contributions you've made to that 403B plan. And if you've maxed out your contributions to that 403B plan already, you're not going to be able to make any contributions to the solo 401k plan, whether employee, whether employer contributions, whether voluntary after-tax solo 401k contributions. So the 403B rules are on the opposite end of the spectrum when you compare it to a 457B, and then the solo 401k and the 401k are in the middle of the spectrum. So again, some key takeaways is that self-employment compensation for sole proprietors is calculated as line 31 of the Schedule C minus 1/2 of self-employment tax. for tax year 2025. You can contribute $70,000 to a solo 401k as part of the Mega Backdoor Roth strategy. And if you're age 50 or older, you can also do catch-up contributions, or if you're age 60 through 63, you can do a super catch-up contributions, but those would get deposited directly to the Roth Solo 401k or the pre-tax Solo 401k for tax year 2025. Now, I know that there are some regulations that were promulgated resulting that impact catch-up contributions, but those regulations impact contributions for tax year 2026. We'll do a separate webinar on that, but let me share that link here so you can have it at your fingertips, and we'll talk about it here briefly. The regulation that I'm about to talk about is, let's see if I can find it. They're basically, instead of being able to contribute those catch-up contributions to the pre-tax solo 401k, you're going to have to deposit those to the Roth Solo 401k. But that only applies if you're self-employed business as an S corporation, or a C corporation, or an LLC tax as an S corporation, or an LLC tax as a C corporation. It does not impact partnerships or sole proprietorships. Let me share that link with you here. Take a look at that. We'll do a webinar here in the coming weeks regarding that new regulation. So let's continue here. Give me a moment. So let's take a look at some more questions here. I just want to confirm my last question. Is it $70,000 or $77,500? It's going to be $70,000 because, again, the Mega Backdoor Roth strategy consists of making voluntary after-tax solo 401k contributions. Voluntary solo 401k contributions are only allowed up to the $415 overall limit, which is the $70,000 figure, regardless if you're age 50 or older. That's the maximum you can make into a voluntary after-tax solo 401k, which would then get converted to the Roth Solo 401k or the Roth IRA. Looks like, can you define eligibility for catch-up contributions? I think we've already talked about that a few times. But again, catch-up contributions are known as employee contributions. So those are aggregated between all plans. All right. Let's take a look at some more information here. Why you can't do this at Fidelity or Schwab, we talked about this already. This, we're talking about the Mega Backdoor Roth strategy. So we covered that slide already. So here's an example of the Mega Backdoor Roth strategy. So you have to make the contribution into the designated account. Designated account is the brokerage account or bank account for the solo 401k labeled voluntary after tax. You make the contribution into that holding account as part of the solo 401k plan, and then you convert that amount to the Roth Solo 401k or to the Roth IRA. Then you'll complete our form 1099-R request form, the conversion form online, once you've converted those funds, and then we issue the form 1099-R as long as you timely request it. So here's a good slide for future reference regarding how contributions to a solo 401k plan have to be based on earned income from self-employment activity. If you look at this slide here, we have links to the sole proprietorship page, S Corp, C Corp page, partnership page on our website, where we go in depth regarding contribution calculations and deadlines and types for those types of self-employment entity types. Okay. That's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here again in a few hours with more crucial content. Until then, have a good rest of the day.